Hi, this is Andrew with the Andrew Smith team of eXp Realty with your March 2019 real estate market update. Now, even though all real estate infinitely is local, or ultimately is local, I should say, what goes on at a national level or even a regional level definitely has an impact on it. And it's important to kind of take a look at some of those trends and some of what is happening across the country in order to get a better idea of what is happening in our local markets. And for the past couple of months, we've been talking about several things that have made headlines. Is the market heading for a crash? The market's in a shift. What exactly is a shift? Is now a good time to buy? And, to be honest with you, I'm not going to, shake pom-poms around and go, real estate's great, buy, or now's the time to sell. If it's not, I just want to kind of break down some of these headlines and give you some of the facts, show you what's actually going on and what we see going forward. Now, it's important to understand that from a national perspective in the headlines, bad news sells. There's not a whole lot of good stories. If there are, they're buried towards the end of a broadcast or, tucked away at the end of an article. Bad news and, significant headlines are what sell. And that can have an impact on you. And so I just want to cover a couple of those things and lay some groundwork before we get into our local numbers. And I think Sam Kater, who's the chief economist for Freddie Mac, said it best. And reading his quote here, he said, "We're in a mental recession. It's a constant stream of negative headlines for a couple of months. It wears on you." And then that's exactly true. That does happen, and we see it all the time. And what it leads to is uncertainty. And uncertainty leads to confusion. Confusion leads to concern. Concern leads to fear. Fear turns to panic, and panic causes paralysis. And I think in one way or another, we've all kind of experienced that range of emotion and that set of circumstances in our lives. And so in the shift in the market that we've been seeing, the transition, if you like, it started last fall and it's been continuing through where we are presently. And when you're in a market like that, from a seller's perspective, sellers are looking backwards. Sellers look at what happened previously. Well, last summer, my neighbor's home sold for this, or every home is getting multiple offers. And they see that, and so they price accordingly. Buyers, on the other hand, see the headlines, see that interest rates have been rising, and they look forward. So you've got forward-looking buyers and backward-looking sellers, and it creates a transition period where there's uncertainty, which leads to a slowdown, which, as we've explained in previous videos. But where are the numbers actually at, and where do we think this is going, and especially as we look forward to 2019? Well, according to the Mortgage Bankers Association, Fannie Mae, and Freddie Mac, they've independently all forecast that total sales for 2019 will be above what they were for 2018. So overall sales for 2018, it was not a bad year. So they're expecting an increase in overall sales. With regards to pricing, has pricing shifted down or turned down in some markets over the past few months? Yes, but year over year for the most part, and in most markets, it's still up. Although there may have been a monthly decline, year over year prices are continuing to increase. And that's actually what we talked about a few weeks ago. We forecast that prices would probably go up somewhere between 2 and 3% this year. Now, here's what's interesting. Historically, going all the way back, real estate appreciates at a rate of about 3.6% per year. Now, that average is taken into account every downturn, every recession, every upmarket, and just average it all together and put forth a trend line. And I've actually got a graph for that I'm going to show you now. All right, what we're looking at here on this graph is the blue bars represent what the median sales price in the U.S. would be if we were following the historic average annual appreciation of 3.6%. The trend line, so to speak, following that 3.6% appreciation rate. The gray bars on the graph are showing the actuals,
Well, as you can see, in 2002, starting in 2002, the actuals started exceeding the trend line by quite a bit. It stayed that way up until 2008, and we all know what happened then. Boom, the bubble burst. And you can see there was a huge drop-off in pricing between 2008 and 2009 that actually nationally continued declining until 2012. Then we started experiencing the big run-up in price that we've been used to for the past several years. But even with the appreciation we've had in the past several years, in essence, we've just been playing catch-up. Because as you can see, at the end of 2018, the gray bar is still below the blue bar. So what does that mean going forward? It means we're not in a bubble. If we were actually to look at this graph going all the way back years and years and years, you would see everything continues to follow that trend line. Every housing bust and boom we've had has followed that same trend line. So right now, we still have some room to go to get back to historical averages before there's any talk of moving into dangerous territory.
Now, the other piece of news that's been kind of floating around and its impact on housing has been, is the country heading for a recession? All right, and I think it's important to understand that a recession and a housing downturn are not necessarily the same thing. And if about 3/4 of all economists that have been surveyed indicate that we probably are going to be into some sort of a recession by the end of 2020. It's going to be interesting. 2020 is an election year. You don't usually see a whole lot of recessions start at that point, but they do think that there will be some form of a recession by the end of 2020. Now, it's important to understand that the term recession, economically speaking, is defined as 2 consecutive quarters of an economic slowdown. But what truly, historically, does that mean for housing? Well, the interesting thing is, if you look at the last 5 recessions, actually better yet, I've got a graph for it.
Looking at this chart here, you can see that in 3 of the last 5 recessions, home prices actually appreciated. They actually went up. In one of those recessions, they went down, but by less than 1%, which would have hardly been noticeable. It was only in the last downturn, late 2007, 2008, which wasn't really a set recession. It was more like a complete crash, that we had a drop-off in prices. So a recession doesn't necessarily or automatically mean that home prices are going to decrease.
Now, I think this information is best summarized by a quote I have here from Morgan Housel. And Morgan is a well-renowned financial analyst. He's interviewed by a lot of different papers, appears on the morning talk shows from time to time. And in his words, an interesting thing is the widespread assumption that the next recession will be as bad as 2008. It's natural to think that way, but statistically highly unlikely. It could even be over before you realize it began. So it doesn't look too bad for housing at all. I mean, anything that we're going to see, it looks as though pricing in the real estate industry is going to be in for what we would consider a soft landing. As we turn our attention to the local market here in Frisco, I'm not going to quote every single stat or go through any history. It'd take too long and be really boring. But if you happen to be seeing this on the blog, then all of the charts and graphs I'm referring to can be seen directly below. If you're not seeing this video on the blog, then please feel free to visit the blog if you'd like to look at some of the detailed numbers. And you can find that at www.theandrewsmithteam.com/blog. And you can look for the March 2019 Frisco real estate market update. Now, I think the most important thing to point out is that the market here, we're heavily impacted by new construction. There's so many new homes being built, and some of those homes get listed in the MLS, some of them don't. Some of them can skew numbers. It's a lot of competition for new buyers, etc., etc. For these stats, I actually took new construction out. So I'm only looking at the resale side here. If you have specific questions about new construction, just shoot me an email, and I'd be happy to answer those for you. But the bottom line is the market has gone through a transition. Over the course of a year, our market kind of does this. It peaks in the summer. It is more seasonal here than I see in my Southern California markets. It's not that we get really bad weather, so I've never understood it completely, except after Halloween, November, December, January, sometimes even into February, you definitely see a lull in activity here, and then that usually comes back towards the spring. Now, even with that being said, when you look at total sales, closed sales were down. Actually, they were down 42% year over year, which sounds like a lot, but it's actually not really any reason that I see to be alarmed. It's following the pattern that it has the past few years. And what I looked at instead was I went and dug into the pending sales, because pending sales are properties under contract. And those give a good indication of future closings and activity. And if you go back just to December, our pending sales are up 30%. So that, the market coming out of hibernation is something that we're seeing. Now, new listings were up 12.3% year over year, which is great news because the market had been needing more inventory. All of those bidding wars and everything that you saw was a result of lack of inventory. So the inventory is coming back. In fact, if you look just at the total inventory number, it's up nearly 43% year over year, which sounds fantastic. And it's like, wow, inventory is way up. But that still only represents a 3-month supply. Now remember, 6-month supply is considered a balanced market. So even with that big increase in inventory, we're still only at a 3-month supply. And again, pending sales are up 30% as well. So a lot of that inventory is already starting to be absorbed. Now, to put that in perspective, last June, we were at a 4-month supply. So even in the height of the summer season, we had a higher supply of inventory. Now, days on market has increased. It's running right around 70 days on average right now, which is up, but it's actually the highest that we've seen since January of 2018. Not surprising to see that as the market transitions and sales have slowed so dramatically during the winter that this days on market is reflecting homes that were listed for sale back in November, beginning of December. So I personally expect that days on market number to come down a little bit as we move forward into the spring. But even saying that, the average sales price continues to go up. We're actually up 6.2% higher than we were a year ago. And the average sales price actually had been declining since July of 2018 as we really started to see the impact of the shift coming on, with buyers pulling back because of interest rates going up. But again, interest rates have dropped back down. So that number right now at $418,000 for an average sales price in Frisco for February of 2019. Overall, though, bottom line is the market still looks strong. We've still got so much industry, so many people moving into this area that it's going to be hard for it to take any sort of really big hit. It is bouncing around, kind of, as I said, waking up and finding its feet as it has been transitioning a little bit. But overall, there's no major red flags that I'm looking at right now. But if you've got a specific situation that you'd like to talk about, please feel free, reach out, give me a call, shoot me an email. Always happy to talk and help you plan out your real estate goals for 2019 and develop that plan that's best for you and your family.